Today we're going to be talking about the government's June 2026 paper entitled Simplification, Modernisation and Fairness in the Tax System. So Dominic, this was a bit of a bombshell announcement by the government, wasn't it? Not one we were expecting at all.
Welcome to Larking Gowen Insights, accountancy and business advice for all. A series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hello, I'm Gilly and McGill and I'm joined by partner in Larking Gowen, Dominic Carter. Today we're going to be talking about the government's June 2026 paper entitled Simplification, Modernisation and Fairness in the Tax System. So Dominic, this was a bit of a bombshell announcement by the government, wasn't it? Not one we were expecting at all.
No, I think that's absolutely right. It's certainly right for the consultation paper that was launched in respect of modernising the tax treatment of distributions and repayments of capital. But before we get on to that, Gilly, could you enlighten us as to what the VAT changes were that were announced?
Yeah, so we had some things that had been well trailed and we were expecting, but we also had a few of those unexpected announcements as well. The first thing that has been confirmed, which is really very welcome news, is that the options tax system is going to be fully digitised. So you'll be familiar with all of the struggles that we fairly frequently have, particularly when a transaction is looming, when we're trying to find out whether land or property has been opted to tax or not. And that often requires us to write to HMRC and ask them to search their records for the last 20 years. Over time, this digitisation project will remove, hopefully, that whole uncertainty. We're told that this will be live before the end of 2026, so looking forward to it with great anticipation that there will no longer be this paper trail that we need to keep for options to tax. So that's very welcome news.
That does sound really helpful, doesn't it? Because I know from practical experience that can be a real nuisance and have real-world impact for concluding transactions where the VAT advisors are really keen to understand what option to tax have been made.
So hopefully good news. And the other really good piece of news we've had is that was already known, is that the capital goods scheme threshold is going to be increased. So this was announced in, I think it was spring 2025, but with little detail about when the change was going to take place. But we now have confirmation that with effect from 29th of July 2026, which is a rather odd date, the capital goods scheme threshold has increased from £250,000 to £600,000. So that means that there'll be far, far fewer capital projects that need to be monitored for the capital goods scheme 10-year period. And also, computers have now been completely removed from the regime. Not that I think I've ever seen more than one in all of my career, but yes, certainly a very welcome piece of modernisation for capital goods scheme projects there.
That sounds incredibly helpful, Gilly. What happens in those cases where acquisitions have been made that are caught by the capital goods scheme in the past? Will they be taken out as a result of these changes if they're below the new thresholds?
No, it's a bit of a cliff edge change. So expenditure prior to the effective date stays under the £250,000 threshold until the capital goods scheme life extinguishes. It's only expenditure that starts being commenced after the effective date that's within the new £600,000 threshold. So again, as with the option to tax digitisation, it'll take a little while before we really see the benefits of this, but nevertheless, it's really good news. Another piece of really good news that we've had that, again, we were expecting but has now gone to a formal consultation is the zero rating relief for land that is being sold to a housing association. So this has always been very problematic when you're selling land to a housing association and they're going to use that to build social housing perhaps, or even market rent properties. it's possible for the housing association to force the seller to disapply their option to tax, meaning that they're going to make a VAT exempt sale, which obviously benefits the housing association, who aren't able to recover very much VAT at all, but it does then prevent the seller from recovering the VAT on the costs that they're incurring in relation to that transaction. So if we get a zero rating position in place, then it's good news for both landowners and for housing associations, and possibly might mean the end of any golden brick planning structures that we've had to put in place in the past to try and improve VAT costs for housing association projects.
That's a shame from my perspective, Gilly, because I've always been in awe about what these golden brick contracts were. They sounded so impressive, but that's probably not the case, is it? That was really just addressing the difficulties that were posed by the VAT regime and how it treated those transactions before now.
And just introduced quite a lot of complexity and uncertainty, and probably professional time costs as well. So hopefully all of those things will be a lot more straightforward in the future. We've got other consultations as well. I'm having to check my notes because these were ones that we weren't expecting at all. We have got the consultation on whether online marketplace rules should be extended to cover UK businesses. At the moment, they only apply to overseas sellers. So if you have a non-UK seller who is making sales on an online marketplace, then the marketplace themselves has to account for VAT appropriately on those sales on behalf of the seller. That is potentially going to be extended to also cover UK businesses. So UK sellers selling on marketplaces, the marketplace will take care of their VAT rather than the seller themselves having to worry about that. So lots of difficulties to resolve there, but broadly, I think fairly welcome as reducing a bit of complexity for online sellers. We've also had consultation on mandatory payments by direct debit, so mandating that VAT is paid by direct debit rather than by bank transfer, which is currently possible. That's a little bit more controversial, in my opinion, than the other consultations that we've got. We had a discussion with one of our clients who are trustees of a VAT registered trust, and the issues that they will have from a governance perspective in making sure that payments of VAT that are paid by direct debit are actually approved by the trustees in the way that they must be, in accordance with their good responsibilities and good governance, is going to be quite a challenge for them to administer.
So they're going to need to think of ways to revisit their procedures to make sure that the trustees are operating with the clear approval that they need in order to be able to submit returns. Because at that stage, then HMRC will simply take the amount out on the direct debit without any further human intervention from your client.
Yeah, exactly so. So, I mean, it will help prevent late payments, I suppose, but there's a lack of control there that I think is a bit worrying for probably not just trusts, but those in particular come to mind as ones that might find that a little bit uncomfortable. Then we've got some what are being described as explorations by HMRC and the government. One is looking at whether supplementary information should be provided alongside the normal 9 boxes on the VAT return. So for those of us who remember when Making Tax Digital was introduced for VAT a number of years ago now, at that point in time, there was a suggestion initially that more information than just the 9 boxes would need to be submitted digitally to HMRC. That never happened, but this appears to be another look at whether that's feasible and whether that information would be helpful to HM Revenue and Customs, which I'm guessing it probably would be, because it will enable them to tie together what's actually appearing on returns and all the way through the supply chain between sellers and customers as well. So watch this space. That one's possibly going to be really tricky. And lastly, on the VAT front, although not really VAT, it's kind of been badged as such, is confirmation that the mandatory e-invoicing that is going to be introduced from 2029, so not really that far away now, is going to be applied using the People platform, which is a very well-known platform used in a number of EU countries, but we have confirmation of that now. So that e-invoicing program is going ahead. It seems full steam ahead. For very large businesses, they might already be doing this, because if you're dealing with government departments, you're already having to submit e-invoices. But for the rest of us who are just dealing in a normal business-to-business environment, this is going to require some probably additional software and a little bit of thinking about how exactly you get your tax coding correct on invoices that have no human intervention in them being generated or received. So that will be interesting. So that's a little canter through all of the kind of VAT related matters. But now let's turn to the big one, which is a corporation. Well, I say corporation tax. It's corporation tax, income tax related issue, and a big consultation that you have been looking at, Dominic.
Yes. Well, that's, exactly the point. It is a consultation that relates to clauses that are basically in our Corporation Taxes Act. So you're thinking this is going to be something that's going to affect companies. But in fact, that's not the case. The legislation in question is within the corporation tax legislation, but it's only its impact on individuals and trustees, who are, of course, all in scope to income tax, that is relevant. And the government and HMRC have stated that they're not expecting anything to change for companies as a result of these changes. So it's all a bit sort of interesting to start with. But I suppose, what are they looking at, and why are we quite worried about it? We've got to probably start off by saying that the type of transactions that are covered there are of relevance to a relatively small number of taxpayers generally. Probably quite a number of our clients will be affected, but overall not huge. But the implications for those who are affected could be very significant. The consultation is on the taxation, or modernising the tax treatment of distributions and repayments of capital from companies. So the sort of transactions that may be caught, depending on how much of this is acted upon, are company purchase of own shares, which is quite a common transaction which companies are involved in if they want to buy out a shareholder who's perhaps leaving or perhaps dissident, and there's a disagreement and it's been agreed that they should have their shares bought, they should cease to be a shareholder, resign their directorship if they're a director, and leave the company for everyone's mutual benefit. It also extends to other types of transactions, such as buyout transactions. So you might have a management buyout, for example, that type of transaction where it's a bit like a company purchase own shares, but we're putting a new company in place to effect the buyout in a way which makes sense from a tax perspective, both for the people who are buying in and the people who are selling out, and allows the consideration from that transaction to be paid without significant leakage of income tax.
So is the idea with both of those, a purchase of own shares and a management buyout or any other buyout, is to try and achieve a tax neutral transaction when the transaction's taking place?
Well, effectively, the ideal solution would be to get to a position where the person who's having their shares bought is paying capital gains tax on that rather than income tax, because capital gains tax is charged at a lower rate, the main rate 24%, compared to 39.35% for income tax on distributions. So that's normally the goal with the company purchase of own shares or with a buyout type transaction. It goes a little bit further than that, because as well as the proceeds that are actually receivable by the person who's selling their shares, you have to think about where the money's coming from and how it's being taxed to buy them out. So a company purchase of own shares is very popular because it uses the surplus cash that's there within the business, or maybe the business will borrow to raise the cash, and it pays it out. So it's more efficient than the other shareholders all buying the shares from the shareholder who's leaving, because that would mean they'd have to take a dividend, for example, in order to be able to have the cash to buy the shareholder out. And it's the same in a sort of typical management buyout type structure as well, where you have a new company in, and the aim will be to use present or future cash within the business or to be generated from future trading profits to pay out the departing shareholders. So that's how those transactions work, basically. The risk is HMRC are looking at a wide range of aspects of these transactions. So the first and most obvious one that they're looking at is the fact that in a company purchase of own shares, you basically have to meet certain rules to qualify for capital treatment, which means you should pay CGT on your disposal rather than it be taxed as a dividend. And to do that, there's certain conditions that have to be met. So HMRC are looking at tightening up those conditions that would apply. So more restricted number of people in those sort of situations would benefit from capital treatment. But there's another little quirk within the legislation that's been around for as long as I can remember, which says that even if you fail those tests, and you would be taxed as a dividend if you've done something like putting a new holding company in place over the course of time, you've managed to successfully take a proportion of the total proceeds that you receive on a subsequent share buyback out of income tax. And again, you'll pay capital gains tax on it. So that appears to be one of the things that the revenue have got their sights on.
Okay.
Along with examining some of the other anti-avoidance provisions around these type of scenarios. And where it will land, we don't really know at this point. And how HMRC will do it is also up in the air, because many of these are commercially driven transactions, and to erode the ability for them to be, the proceeds of these transactions to be taxed efficiently and for them to be funded tax efficiently would have some, as I said before, real world implications for businesses, their owners and their managers. The third type of transaction that we were worried about when we read the consultation paper was that we often are asked to deal with companies that are looking to demerge their activities. So if we have a company or a group which is carrying on different activities, there might be a desire to separate that out so that the businesses can operate independently. And that might be for commercial reasons, or it might be because the ownership of the two sides of the business need to diverge, either immediately with them being separated. You might have shareholder A and shareholder B, or two shareholding families, and they've agreed that one of them will take over one part of the business, the other will take over the other, and they no longer wish that to be operated as a single entity. So a demerger is really useful in those type of situations. And probably for a number of years now, getting on for 20 years, there's been quite an efficient way of doing that from a procedural perspective, which is known as a capital reduction demerger. Back in the days when you and I started to practice tax, Gilly, we were used to weird and wonderful things involving liquidators being appointed to effect some of these transactions. Yeah. And there's a little known way of doing it, little used, widely known, but that doesn't work very well in most practical circumstances, called a statutory demerger. So the capital reduction demerger quickly became the favoured way of doing this. And unfortunately, that relies on the same sort of mechanics as what happens in a company purchase of own shares, whereby you get this amount being taken out of income treatment, because if any of these demergers end up being subject to income tax at distribution rates, that would kill them off. They wouldn't be able to do the transaction. Or one of the older, clumsier alternatives would have to be used. So again, there'd be some real implications to doing that. So basically, those are the sort of three types of transactions we were worried about when we first saw the consultation paper. Q, immediate tax advisors sort of advising all of their clients that if they were anticipating any of these transactions in the foreseeable future, they may wish to think about accelerating them. And
well, that's a good point, Dominic. What is the timescale for this? Are we expecting any change in the budget in
that's
November,
a really good question.
October?
We were initially thinking, something could be coming in the budget now, because the consultation runs until early September. Okay. And then what would typically happen would be that HMRC and government would review the consultation responses, and they would then provide their response to the consultation responses and say what they were going to do, or they might then launch a further consultation to focus in on some of the technical aspects where they wanted to make sure it would work. So that's the normal thing. We were thinking the earliest date that something could credibly happen would probably be from an autumn budget at the time. Naturally, we didn't know what the date of the budget would be. That's now been announced as the 28th of October. But that was the thinking. And therefore, it would have been prudent if you were doing a share buy, demerger or whatever it was, to have tried to target completion before an autumn budget, which would have been pushing it in some cases because we have to write to HMRC to obtain tax clearances and lawyers have to be engaged and so on. I think the mood music coming out of HMRC is more that these are long-term changes where they're examining aspects of the tax legislation that have been in play for many years, in some cases going right back to the beginnings of corporation tax in 1965. And they want to do a good job of it. There's no specific avoidance which anybody is involved in, which they need to shut down in a big hurry. So as a result of that, there have been meetings between HMRC and the professional bodies, and that's broadly what HMRC have indicated. Now, the extent to which we can place any comfort or reliance on that is clearly up in the air. I mean, I'm not saying that one would instinctively distrust HMRC, that I'm sure they wouldn't go about things in that way, but that's how things stand at this point. Since then, we've had a new government as well.
I was going to say, it's worth noting that we've had a new government since this paper was released, so things might have shifted.
Exactly that. And one of the things that I think is always on the agenda for politicians, and of course came up in the course of the Labour Party leadership contest, was the disparity between income tax rates and CGT rates. And the headline is often, why is it that a cleaner pays a higher rate of tax than a private equity fund manager, or something like that. So it's always a focus, what should be done about that. You can't rule out the possibility that the two things come together and somebody decides that it would be a good thing to do to accelerate this process and push through changes, particularly if they have the effect of further limiting the number of transactions that would qualify for capital gains tax treatment. But at this point, that's not HMRC's apparent intention.
Okay. Well, that's somewhat reassuring, I think, because certainly the initial response was quite shocked.
Yes, it was all over LinkedIn and everywhere, wasn't it? Within about a day or two, and every accountant was putting a blog out or what have you. But I think as a result of that, HMRC have a chance to better communicate their intentions, and maybe we've come to a slightly happier place. Although I would probably say that for any clients we have or any taxpayers who are actively looking at carrying out these transactions and have engaged advisors to do so, it would seem prudent for them to move those transactions forward as fast as possible and ahead of the budget if it makes commercial sense for them to do so.
Noted. Okay. So thank you, Dominic. I think on that note, it's worth just saying that Larking Gowen will be holding a number of budget events around the budget on the 28th of October. So please do sign up for those if you would be interested in attending. Get in touch with Dominic or me if you've got any questions or would like to discuss, or perhaps input to the consultations that we've mentioned in this brief conversation. All of our contact details can be found in the show notes.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.